I am Deepika Prakash from National Law University, Delhi, and this presentation is about auditors, their duties and liabilities under the subject of corporate law. This presentation will elaborate on functions of an auditor for representation of true financial status of a company. The major focus of it is to give an overview of the duties and liabilities of an auditor under the Companies Act 2013 for the broader objective of corporate governance as a whole. Now, corporate governance has become the cornerstone of corporate law globally. True and fair audit are the core concerns for regulators world over. The new Companies Act has made accounts and audit a subject of special interest and has laid down detailed provisions regarding the same. The Act has also set up a national financial reporting authority for setting the standards for the accounting and auditing. Now, a company carries on its business with the capital provided by the shareholders and other members of the investment community. It is important for them that their investment is safe and that it has been used for the purpose it was intended to be. The company has to maintain number of financial books, accounts and statements for the proper accounting of the income and expenditure. Now, these account books etc. must be inspected and verified by an independent person or a firm to give a true picture of the entire financial functioning of the company. The Institute of Chartered Accountants of India, ICAI, is a statutory body established under the Chartered Accountants Act of 1949, which regulates the profession of chartered accountants in India. ICAI lays down the pre-qualifications, accounting standards, code of ethics, as well as education of auditors in India. Now, only persons who are members of ICAI with a valid certificate of the Institute for Accounting may be made an auditor of a company in India. The question that comes before us is, what is auditing? The main objective of auditing is to evaluate the financial statements to confirm they are accurate and truly represented in the reports. In case auditing and accounting is not done soundly or effectively, financial scams like Satyam's happen, which adversely affect the investors in the company. Let us look into the Satyam Scandal briefly. Satyam Scandal is also called the Indian Enron. Satyam, an IT company, won the Golden Peacock Award for the best governed company in 2007 as well as in 2009. It was India's fourth largest company. Satyam Scandal has turned out to be nation's biggest corporate scandal. Now, how was the scandal revealed? On 7th Jan 2009, the company's then chairman and founder, Mr. Ramalinga Raju, disclosed in a letter to the Satyam Computer Limited Board of Directors that he had been manipulating the company's accounting numbers for years. Mr. Raju claimed that he had overstated assets on Satyam's balance sheet by $1.47 million. Nearly $1.4 billion in bank loans and cash that the company claimed were non-existent. A number of liabilities were also left underreported in the balance sheet. Satyam's income was also overstated almost every quarter for many years. Mr. Raju and the company's global head of internal audit used a number of different techniques to perpetrate the fraud. Using his personal computer, Mr. Raju created numerous bank statements to advance the fraud. He falsified the bank accounts to inflate the balance sheets with balances that did not exist. He also inflated the income statement by claiming interest income from fake bank accounts. Mr. Raju also revealed that he had created about 6,000 fake salary accounts over the past few years and appropriated the money after the company deposited it. The company's global head of internal audit created fake customer identities, IDs, and generated fake invoices against their name to inflate revenues. The global head of internal audit also forged board resolutions and illegally obtained loans from the company. Now, the founder of Satyam was subsequently arrested after he admitted falsifying the firm's accounts. Mr. Ramaling Raju was charged with several offences, including criminal conspiracy, breach of trust, and forgery. Satyam's share fell to an all-time low in the stock market. The auditing company PricewaterhouseCoopers audited Satyam's book from June 2000 until a discovery of the fraud in the year 2009. PwC has been severely criticized to give inaccurate and unreliable audit report as well as failure to detect the fraud. Now, looking at the Satyam Scandal, role of an auditor and auditing in corporate governance has become quintessential for the welfare of the company. They also play a vital role in securing the interest of shareholders and investing communities in India. For fair and accurate auditing, the new Companies Regulation in India, which is the Companies Act 2013, under Chapter 10 has brought several changes in the position and responsibility of an auditor in a company functioning in India. Let us look briefly into these provisions. The very first provisions regarding auditors is about appointment. Section 139 of the Companies Act lays down that an individual or a firm, which includes a limited liability partnership under Section 139(4) and I suppose 141(2), can be appointed as an auditor in a company. The first auditor of a company is to be appointed at a board meeting within 30 days of registration of the company. In case the board fails to appoint within 30 days, the board will inform the members and the members shall appoint the auditors in the extraordinary general meeting of the company. Every appointment will be for 5 years, provided that the company places the matter relating to such appointments for ratification by members at every annual general meeting. Auditor or auditing firms so appointed must give in writing consent on such appointment and certificate for himself or it that the appointment has been made in accordance with the conditions prescribed and the auditor satisfies the criteria provided under the Act. A notice of this appointment must be filed with the registrar of the companies within 15 days of the meeting which appoints the auditor. These were some general rules regarding the appointment of an auditor in company. Now, coming to certain additional conditions of appointment under Section 139. Under Section 139, subsection 2 of the appointment provision, no listed company or some other company as notified shall appoint as well as reappoint an individual for more than one term of the 5 consecutive years or an audit firm for more than 2 terms of the 5 consecutive years. Any audit firm which has a common partner with the audit firm whose tenure has just expired with the company may not be appointed as well. The companies are required to comply with these requirements within 3 years of the implementation of the Act, that is from 2013 onwards.